It's Brian Preston, the money guy.
All right, here's another one. This is another kind of academic one. This is from Zumba Elena. I bet she does Zumba. Just a shot. Question.
She might teach Zumba.
Maybe she teaches Zumba. Hey, you should accept Solar 401k. Love it. How does 401k withdrawal rule work if the market tanks? We get this question all the time. Say you have $1 million, and next year it's worth $500,000. Which one of those balances do you draw 4% from? Is it the million or is it the 500? I actually love this question because this is one of the fallacies I feel like I see in the in retirement circles all over the place. They get so caught up on this idea of the withdrawal rate. We think, in our opinion, the withdrawal rate should be the thing that lets you cast vision on the portfolio that you're building towards. When it actually comes time to distribute, your withdrawal rate is something that you should monitor as you move through retirement to make sure that you don't get out of whack. This may be surprising to a lot of you, but for the majority of retirees, they don't have a flat, static withdrawal rate that stays at exactly 3.27% every month or every year or every couple of years. Rather, it's much more fluid than that because what ends up happening is when we retire, often our expenses are fluid. We have some level of fixed expenses, but then we might have to do home improvements or buy cars or we want to travel or we have these things that might cause our annual year-over-year withdrawal rate to kind of go up or down. So the first thing I would say is it's not something quite so static. Here's the second thing I would say that I think is really, really interesting, specifically in your question. If you are retired and you are drawing off of your portfolio, and you're in a portfolio that this year is worth $1 million and next year is worth $500,000, you may have a problem. There may be a risk component inside of your portfolio that you have not taken into consideration. Because I would argue for someone in retirement living off of the assets, a 50% swing in portfolio value is probably less than ideal.
Well, you're bumping into what's called risk capacity because we know a good diversified portfolio, you hit even a great recession type downturn, you're probably going to be back to making money within 2 to 3 years. Sure. Whereas if you're too far out on the risk spectrum and you're actually living off these assets, it might take 6 to 7 years to actually recover. That's just too long if you're pulling off because you will eat your corpus alive if that's the case. I want to answer the question in a little different way in the fact that I like when I'm doing retirement planning to do a goals-based retirement plan that is influenced by not only a safe withdrawal rate but also the Monte Carlo simulations as well as your personal living expenses. So you get the freedom, if it's goal-based, if you have a big goal that, you have your travel wish list that you want to go to Australia for 3 weeks this coming year because you felt all locked down for the last year because of the pandemic. I want that built in. Now, that might be the travel expenses of the next, of the equivalent of what would be normally 4 years. Sure. But if it's goal-based planning based upon your actual living expenses plus what you've built into the plan, it's going to be much more dynamic and actually be able to absorb what's going on and reflect you better than just a static percentage that you're using kind of in the early stages of building wealth. I think if you're in your 20s, 30s, 40s, use the safe withdrawal rate to do the napkin planning to see where you are in your retirement savings. But if you actually get to the future and you're close to retirement, you're kind of skipping some steps by just using that. It's not very dynamic, and you run into these weird situations where you're like, well, if it rained last Thursday and the market went down, how does that impact? Yeah. The answer is look, the reality is us humans, we're very emotional creatures. I will tell you from my experience of managing money I'm in my third decade. People, when markets are making money, you're going to kick it up a notch. You just naturally, and that's what I like about a goals base is you're testing that to make sure that you're not getting out over your skis on your spending. When markets go down, naturally the human emotion is you're not even spending your 4.5% to 5% safe withdrawal rate because you're all nervous, you're scared. That's why the economies typically tank in tandem with some other economic downturn and the fact that we all quit buying washing machines. We all quit buying cars. We all quit going on vacations at the same time. It kind of is a pile-on effect, and that's what causes these market cycles. have a dynamic plan that takes into account and is good through all cycles of what's going on in the economic market. And that's the big part of a retirement plan. I'm amazed when I see comments where people tell me they're running their retirement plan with total market index like at 100%, but they're having a 2 or 3 year cash reserves, and they're thinking that's all they need in their diversification, because you just don't know what you don't know on how scary it is when the market gets its teeth kicked in, and you know that there's some point in the future you're going to have to go pull off of those assets, and you can't just go work more, because that's what happens when you're truly retired. It's on more of your army of dollar bills than it is on your back, your brains, and your hands. That's a scary psychological dynamic. Make sure your portfolio reflects where you are from a risk standpoint too, because it's not always the nuts and bolts of what the math tells you to do. It's also balancing out the important parts of the behavioral side of things.
Love it. Love it. Love it.